It's no secret that the financial industry, and specifically Wall Street, has one of the most grueling work schedules in the world, as they often work 80 to 100 hours per week. It's quite common to hear from Wall Street professionals that they start work at 5:30 a.m. and don't finish till 7:30 p.m. or even later. They literally just work, eat, and sleep during the week. But why do they work so hard? Well, starting off, there are only two real types of jobs in the financial industry, which are being a financial analyst or a risk analyst. Virtually all jobs in the financial sector will use these same skills, whether an investment banker at Goldman Sachs or a prestigious hedge fund manager. Taking a closer look at financial analysts, there are two basic types of financial analysts: buy-side analysts and sell-side analysts. Buy-side analysts analyze various investment opportunities and develop several potential investment strategies for hedge funds, insurance companies, pension funds, banks, and so on and so forth. Similarly, sell-side analysts analyze various holdings and recommend which stocks, bonds, and investments a company should sell. Moving on, risk analysts look at each of these recommendations as well as a company's current holdings and evaluate the risk of each investment. And that's essentially the entire financial industry in a nutshell. Small groups of financial and risk analysts will work together to propose the best possible investment strategies for an industry to portfolio managers. Portfolio managers will use the same skills as financial and risk analysts along with their experience to choose an investment strategy for the industry they are in charge of. Several of these portfolio managers report their results to fund managers, who again use the same skills to evaluate which industry to stay in and which to exit. As you can see, the skills required remain constant throughout the financial hierarchy, and the only difference between various positions is responsibility and experience. So once you got the basic skills down, the job itself is pretty easy to do. And one of the main reasons for such a heavy workload is because of the simplicity of the job. Now don't get me wrong here, you need to be knowledgeable in the appropriate skills to be successful at the job, but the job is not necessarily an intellectually challenging job. And as a result, it's very easy to replace. In other sectors like engineering, unless you screw up really bad, you probably won't be let go in the middle of a project. It's usually not worth their hassle to find another qualified person to take over when you are already well into a given project. And you might even be able to redeem yourself by the end of the project. But in the finance industry, they could replace you the following day without any hassle. They don't have to do any training for newcomers, and these guys don't need to have any background knowledge of the work done so far in order to analyze a future investment. So the ease of being replaced often drives financial professionals to be very competitive and work long hours. Moving on, working long hours is often key to the survival of the entire company. The vast majority of financial companies are not JP Morgan Chase or Wells Fargo with millions of investors and investments that taking one investment would be negligible. The vast majority of financial companies are smaller institutions that are dependent on investor capital to continue operation. For instance, there are over 10,000 hedge funds in the world, but only 2,000 billionaires. Of course, billionaires are not the only people investing in hedge funds, but the point is that the financial industry is a buyer's market. Wall Street is oversaturated with investment options for potential investors, so logically, investors are only going to flock towards the funds and companies with the highest returns and least risk. And in an industry where you can't outsmart your competitors given the rudimentary nature of finance, you have to outwork them, as just a few years of bad returns can lead to the collapse of your entire firm. And finally, the last major reason Wall Street works so hard is the pay. It's no wonder that so many people are interested in working in Wall Street, as it is hands down the highest paying industry. Top hedge fund managers make well into billions a year, beating out even the owners of the biggest companies in the world. Even starting out, financial analysts make well into six figures and can quite reasonably work their way into seven figures by just their 30s. Something else to keep in mind is that each position in the financial industry pays exponentially more. And the thing is, the people who enter the financial industry aren't just looking to make a nice income, save up, and retire. These people are highly motivated individuals entering the financial industry looking to become extremely wealthy, and the faster they can get promoted, the faster they can make that happen. As a result, in the end, the long hours worked on Wall Street boils down to one thing: reputation, as this is key to survive in such a competitive environment. Are you the financial analyst that always double, triple checks your work and never makes a mistake? Are you the portfolio manager that always delivers the best returns? And are you the manager of the best fund for the last 20 years? In the financial industry, reputation is king, as it is the only feature that will help you stick out from the crowd. And reputation is not something you get once and you're good for life. As long as you're in the finance industry, you have to continue upholding that reputation. Furthermore, as the financial industry grows and more hopefuls flood in, the competitiveness simply continues to grow, pushing Wall Street to work harder and harder. If you guys thought this video thoroughly explained the motive for Wall Street to work so hard, then make sure to drop a like and consider subscribing to see more questions logically answered. But until then, I'm Hari, and I'll see you guys on the next one.